welcome to the Financial Literacy Club with Mr. Alonzo, and I wanted to make a quick video to talk about how I basically 2x my money this year using options. So if you guys don't know what options are, I'm going to go and quickly talk about what options are or how I think about options. But I basically used options this year. My goal this year was to understand what they were, because I know there's an insane potential to make a lot of money using options in a safe way. So I basically started using options. You can kind of see it right here a couple months ago, and I'm off to a pretty good start. So up to around November, my account was around $8,000, and then now that I'm using options, it dramatically increased to now almost $15,000. Okay, so I kind of want to explain my strategy on how I am doing that. And first I want to explain what options are. Here you can see all of my different options, what I think about. So we'll maybe go into all of the different why I pick certain options and why not, but I wanted to go into a brief explanation of what are options and how I use options. And the strategy that I use is called a poor man's covered call. So if you want to do more research, that's what it's called. It's a poor man's covered call. Okay? So the way that I think about options is I kind of think about it like buying a house. Okay? So if you have a house, you go and you buy a house, and you can also rent out that house, right? You can take that house and let someone stay there, and they pay you rent. Okay, that's kind of how that metaphor, let's stick with that metaphor, that's how I view options. It is a way to, let's say, rent out your shares that you own, even though you kind of don't own them, right? So, and it's a way to get leverage, right? So then when we are buying a house, you kind of you need a mortgage, you need all of that, you need to borrow some money. So what I'm basically doing is I'm borrowing 100 shares from somebody else, and I am loaning it out to somebody else. So, and I'm going to get basically rental income through options, okay? So basically, instead of buying 100 shares, because everything with options is 100 shares, I'm going to borrow those shares, and then I'm going to loan it out to somebody else for an income. Okay, so that's the way kind of options are. So if we buy a house, let's see, that's kind of the metaphor, right? So now let's get into like specifics. So if you think a stock is going to go up and you want to borrow those 100 shares, you can pick the amount of time that you want to rent out those shares, right? So what I do is I borrow those shares for a very, very long time. I say, I'm going to buy this call option. This is the technical word, call option. 2 years out. So what does this do? I am basically renting. It's like I'm renting a house, right? In this case, I am renting 100 shares. Someone's giving me 100 shares of whatever. So I have a couple shares. I have 3 different options right now where I am renting them. for 2 years, I'm renting Berkshire Hathaway. Berkshire Hathaway. I am renting ARK. ARK-K ETF. And I am renting, or I bought this 2-year call option for Intel. Oops. Okay. And here's basically why I picked those 3 things. Berkshire Hathaway, to me, is a deep value play. So it is Berkshire Hathaway is Warren Buffett's company. It buys railroads, has a lot of cash. It buys banks. It buys Apple. It owns a lot of Apple. Very stable things that have worked in the past. So things that have worked in the past. So I think part of the portfolio needs to be what is profitable in the past, what is profitable right now, and is paying and increasing the cash flow every single quarter and every single year, and has a consistent track record of that. So that's why Berkshire Hathaway, that to me means more safety, okay? That is safety. It's past and safety. I know and I trust Warren Buffett and his company. I like his philosophy. He has 20% in cash. If there is a market downturn, he is going to use that cash to buy a bunch of businesses, and they're going to be, in the long term, Berkshire Hathaway is going to, like he said in his meetings, this is going to be a financial fortress. So that's, to me, it is a bet on what has worked for hundreds of years. Okay. Now, ARK, I am young, right? ARK is a bet on the future. Tesla, biotech, Bitcoin, all of those things that maybe not yet have not been proven to be profitable, but they have a team of scientists that pick the best biotech companies, the best, in my opinion, the best electric vehicles, instead of, for example, fintech. Okay, so they pick, so I don't have to do that work. I don't know anything about biotech. I don't know anything about medicine. I don't know anything about that. But I don't have to when I buy the ETF. I have scientists there, and the same thing with Berkshire Hathaway. I don't have to value those companies. Berkshire Hathaway does it. If Berkshire Hathaway doesn't find any investments, they are perfectly fine with sitting in cash, and I love that, because sometimes I've only been investing for 2 to 3 years. I'm going to make way more mistakes than Berkshire Hathaway. I'm going to make way more mistakes than ARK. Okay, and my last option play, a call option 2 years out, is Intel, and I bought Intel option when it was at 45, and I just thought at that price, the free cash flow and all of the income, even if their product and their chips don't do as well as Nvidia's, to me, this is not a long-term play, but it was basically a swing trade kind of thing that I'm going to hold until the share price is at least $70. I bought it at 45. Okay, so I'm buying low at 45. It's already almost up to my target price of at least 70 or 80. Okay, so that is my own. Notice that I have diversification with Berkshire Hathaway of the past, ARK the future, and then my own bet on a specific company because I did the research on that. So I wanted to learn how to value companies, and I just thought at $45 for like a 3% dividend, low PE ratios, they invest more in chips than any other company, was a pretty good investment in the long term. But it is chips are a cyclical company, so they go up and down. So it is not long term. Once it hits that $80, I'm not gonna buy Intel anymore. Okay. So what is my strategy here? I buy this call option 2 years out. My Berkshire Hathaway, I'm renting these shares for about 2 years. 100 shares. So this cost me about $3,500. Okay. This also cost me about around $3,000. Okay. And Intel cost me about $800. There's no comma there. Okay. Now, why use options instead of just buying the stock? This is why. For $3,000, think about this. For $3,000 in Berkshire Hathaway, I am renting 100 shares. Okay? So, renting 100 shares. So Berkshire Hathaway right now is around $240 at the time of this video. If I wanted to buy 100 shares, 240 times 100 is $24,000. I don't have $24,000. Okay? The same thing with ARK. ARK is about, right now, about $155 per share. If I multiply that by 100, what is that? $15,000, $500? I don't have $15,000. If I wanted to buy Intel, it's at 45. Or I bought it at 45, but now it's like 60, 62. So that's gonna be $6,000. Like $6,200. If I add all of that up, 6 plus 4, carry the 1, 6, $46,000 in value. Okay, so I'm renting $46,000 in value, but I really only spent about $7,500. So my risk to lose it all, my risk is $7,000. But my potential upside, it's like I own $46,000 in these shares. So my upside is going to be huge, but now also my downside in these next 2 years, if there's a stock market crash, that's also going to be huge. Okay? So if it crashes below the price that I paid at, then I lose everything. So it is a bet. It's a bet that these things are either going to stay the same or improve in the next 2 years. Okay? And if they do improve, my stock market, for example, if ARK doubles again, so if ARK becomes $300 a share in the next 2 years, I've 4 times my money. 4 times. So I turned probably $3,000 into more than $12,000. The same thing with Berkshire Hathaway. If that doubles, I'm going to 4x or 5 times my money. Okay? So that is the power of options, and also the risks of options are that you can lose it all if it is under that price. So how do we minimize that risk? Okay? How do we minimize that risk of losing it all? Okay? So when you buy a call option, when you rent those shares, you can also, since you are borrowing those shares, you can rent them to someone else and get paid every week or every month or every 2 months, whatever you like. Okay? So if we go, so every single month I'm going to be collecting some income, which that income, let's say it is $300. Every single month is going to lower what I paid for my cost basis. So right now I only paid $7,500 around there. If I get some income out of this, my risk just went down to $7,200. So over the next 2 years, my risk is going to go down no matter what happens. And I am guaranteed some kind of income for 2 years with selling this. Okay? This is way better than stocks, than just buying the stock. So what I'm going to do is going to sell every 3 weeks, every 4 weeks, I'm going to loan it out again, my shares that I borrowed, to somebody else. And they're going to pay me a premium, it's called. Okay? So this is what I've been doing for about 3 months, and it seems to be working really well. Okay? So if we go onto Robinhood, you can see Intel. So there are 2 ways I can make money. Right here, total return. If you notice, I'm up 146% when the stock only really went up $10 to $15. Okay? So I invested $820, and now this call option, because the price went up $15, went up 146%. Because it's like I own 100 shares of that. So that is one way I can make money. But another way I'm making money is every 2 or 3 weeks, if I view options, you'll notice that on March 5th, I am selling right here. I sold at the 63. You'll notice this -1. I sold that call. So I'm loaning out those 100 shares, and if I loan it out right now, it's going to pay me $154. And this is what I get to keep as rental income, I call it, or my premiums. Okay? And this is because I have that call. Since I own that option, I can rent that out to somebody else. So this is going to minimize my risk. This is going to minimize my risk over the next 2 years, over time. Okay? So that is currently what I'm doing with Intel. If I go to my portfolio, I'm doing the same thing with ARK. If you notice, this one is also up over 100%. I started with about $3,000, and now it's worth around $6,000. But not only that, I am selling. So if I go to sell and go to about a month away, March 5th, you'll notice that this one is actually getting really close to this. So this is another one. This one I'm selling for $500 this month. Okay. The risks of this, the risk of selling this is if it goes above this, this has downside protection. So if the stock goes down, this actually gains money. Okay, the selling gains money, but my call, the other long-term call, appreciates in value. So I don't want, in this case, it's almost at this strike price. So I don't actually want to own this. So if it comes too close to that, you don't want to own it anymore. And so you have to buy to close it. I go like this, and if that is the case, I move out a week forward, and I basically break even. If you notice, right here, I break even around 160. This is 550. Okay, I spent $10 to do this trade, right? And if I want it safer, because I don't want it to go above this price, I can go up here. If you notice these percentages, the chance of profit, I can have either a more chance of profit or less chance of profit. The closer it is to the stock price, the more income you're going to get, but it is closer that the stock price will go above it. So there's a higher chance for you to lose money that way, or lose the profit potential. You don't lose money because you're selling it, but you do lose that profit potential because it cuts off your gains. Okay. So I like to be in between 80% profit chance of profit and 70%. Right now, the one that I own, if you look at it, the one that I own is at 68%. So it is time today or on Monday, it is time to move it up to a higher one. But this is protecting me in the downside. So this is why I do it, because of the income. And if it goes down, I can buy it at a cheaper price and protect myself that way. Okay. So it is protecting me on the downside. So this strategy, it kind of forces you to buy low. So you are getting income when you are scared. You are getting income when you are scared, when your stock price is going down, and you get to enjoy the ride up when it goes up. So it is a win. It's riskier if there is a huge crash, right? You lose all of your money if it goes below, but it does have the opportunity for doubling in a couple months. Every single time the stock goes above $10, I make $1,000. So options allow you to have leverage. You get more upside and you get more downside. So if you guys like this type of strategy, the poor man's covered call, what you want to do, for example, is buy something 2 years out. For example, I own the one over here for ARK at 117, 2 years out. So if in 2 years ARK is below 117, I lose all of my money. But if ARK is higher than 117, or higher, let's say it goes to 300, I've doubled and tripled and quadrupled my money. Okay, so this is my speculative portfolio. This is the high risk, high reward portfolio. Do not do this with all of your money, all of your savings. Be smart about it. Like I said, this is my high risk, high reward portfolio. I have a Roth IRA that we can talk about later. It is in the same exact a third of my Roth IRA is ARK, and the other third is Berkshire Hathaway. So it is in the same stocks, but I own them for safety. It is not. It is not in options. So this is how you